Hey everyone, Netflix just dropped their Q1 2026 earnings, posting solid revenue of $12.25 billion. The crowd is euphoric, buying the stock at current prices based on various analyst price targets. But today, we're not just reading the report. We are doing a strict mathematical audit and calculate the real value. I built a 10-year institutional DCF model. Why 10 years? To properly account for growth fade, which standard 5-year models just cut off.
First, let's do a quick business health check. Fundamentally, the company is executing perfectly. Balance sheet, green light. They only have $2.1 billion in net debt. Profitability, green light. Margins are holding strong and the ad tier is working. Cash flow, green light. They are a cash-generating machine. But remember, a great company is not always a great investment if you are paying double what it's worth. Let's look under the hood of institutional valuation. Most beginners build 5-year DCF models. The problem? A 5-year model forces a high-growth tech giant into maturity too early, defaulting to a 3% terminal growth rate and cutting off massive cash flows. By 2036, free cash flow smoothly scales to $25.2 billion. Using a 10.3% discount rate, the sum of our future cash flows plus the terminal value gives us an equity value of $233 billion. Now let's do the real math. I'm handling all the calculations for you here, so we can skip the complicated formula work. The resulting equity value came out to around $233 billion. To get the share price, you must divide $233 billion by the number of shares, which is 4.298 billion. So the real, mathematically proven intrinsic value is $54.21. You didn't expect that, right? At current price, the stock is massively overvalued. There is absolutely no margin of safety here. It's up to you to decide what to do with Netflix, but personally, I'm staying on the sidelines for now. For me, the stock only becomes really attractive around $54 per share, where it approaches intrinsic value with a healthy margin of safety. It also aligns well with the technical structure on the chart, including a fair value gap and a high probability entry area based on Fibonacci levels. This is one of those setups where fundamental and technical analysis align almost perfectly. There's no place for emotional buying here. The setup is defined by math and technical structure. From here, it's all about discipline as an investor or trader. These moments of alignment across different types of analysis are what create truly remarkable investments. But before I let you go, here is the final quarterly report secret that most people missed. That massive $5.28 billion net income you see in the headlines, it's not all from streaming. There is just one-time massive payout from Walt Disney due to their collapsed acquisition deal. Without that artificial boost, the true operating power of the business sits at $3.96 billion. This is exactly why we don't trade based on headline PE ratios. We trade based on raw, recurring cash flow. Netflix is a beast, but you have to know which numbers are real. Subscribe for high-quality analysis that helps you make better investment decisions, and see you in the next one.